Hello guys, and welcome to today's class. Today we'll be talking about cost of debt, and we are going to solve about 7 or 6 different questions. So this class is very important for you if you want to understand cost of debt. If you remember clearly, we've been talking about cost of capital, where we have the cost of equity, cost of debt, and WACC, right? So cost of capital. So we talked about equity, talked about debt, and talked about the two, equity and debt. And equity is KE, cost of equity, cost of debt is KD, cost of debt, and these two is called WACC. And I've explained to you that there are two approaches to determine cost of equity. One is dividend valuation method. Two is CAPM approach. Three is M&M approach. And we've been able to solve questions and discuss this, right? The cost of debt is quite similar to this as well, where we have two major approaches to determine any given cost of debt questions. Are you with me? The first one is interest based approach. Interest based approach or cash flows. The second one is risk premium approach. And do you know what is interesting about any cost of capital question? Don't forget, I told you that cost of capital is the minimum required rate of return, which is denoted as MIRROR. MIRROR. The minimum required rate of return. And I told you that every question in cost of capital, you should always see from the perspective of the investor. Always see it from the perspective of the investor, except the WACC, which combines both equity and debt, right? And see, let me say something, and I believe so strongly that what I'm about to say will change your life. It will change your perspective of cost of capital questions. See, cost of capital is the minimum required rate of return that is expected. So it involves inflow and outflows. For example, using the dividend valuation method, I told you that dividend valuation method consider or determine the cost of equity by considering the amount of dividend paid. So when dividend is being paid, is it an inflow or outflow? It's an inflow to me. Don't forget, see question from the perspective of the investor. So when dividend is being paid, an investor receives it, that is an inflow, right? Exactly. And we said that KE, using dividend valuation method, for example, we said dividend over market value XDIV, right? Yes, dividend is an inflow. It came in. Or let me say inflow. And market value is an outflow, the amount that is being paid, or the amount maybe you invested, or the market value, right? So it's similar to this interest based. Interest is an inflow to the debt holder. Are you with me now? For example, I don't know if I should explain that here right now, but okay, let me just chew. When we begin to move on, I'll make it clearer to you. So we have two methods, interest based approach and the risk premium approach. So let's focus on interest based approach now. Again, as I've said, okay, let's just move on. So focusing on interest-based approach, there are types of debt. Every ICAN question will come around these scenarios. The first one is irredeemable and non-traded. Irredeemable, deemable, and non-traded. The second one is irredeemable and traded. The third one is redeemable and traded. The fourth one is convertible debt. Do you know what I've got to understand or realize during my own personal study? I realized that every cost of capital question, especially equity and debt, just involve inflow and outflows. So the ability to understand what is inflow and outflow will already make the whole question or the whole approach simple enough for you. All right. So irredeemable, and I'm going to explain what I mean by that. Irredeemable and non-traded is saying that when I invest as an investor, don't forget, always a question from the perspective of the investor or of the debt holder. Who is a debt holder? Let me give you a very good scenario. This is a scenario. A company needs HomeLink. It's a particular company that needs to raise 50 million capital, right? So it's going to issue bonds out so that it can raise money, so that people can invest, buy the bonds, right? So the company is called the bond issuer, and I or every other people that buy the bonds, they are called the bond holder. So the bond holder or bond holders are similar to investors, right? So investors is the same thing now. Investor is the same thing as a bond holder. So irredeemable and non-traded is saying that when I invest in a particular company or individual and I give money to someone, I don't expect to get the principal amount back, and it is not traded, as there's no market value for it. So if you have any question, when there is no market value, you're not giving the market value, and they told you that you are not getting your principal amount back, that is irredeemable and non-traded. And a solid example could be that your uncle decide to borrow money from you and told you that for the rest of your life, I'm going to give you interest, but I'm not going to give you your principal amount back. Maybe your uncle borrows, and a very good example for this is maybe your uncle borrows 100,000 naira from you, and he told you that don't expect this principal amount back. I'm not giving you this 100,000 naira back forever, but I'm going to continually give you interest of maybe 10,000 naira for the rest of your life every year. I'm going to give you 10,000 naira every year, but giving you 100,000 naira back, no. That means there's no maturity date, or there's no maturity date for the principal amount of money. So that it's simple. Irredeemable, you are not getting the principal amount back from the point of view of the investor. Irredeemable and traded. So traded is saying that it has market value. It can be traded, right? So that's simply what it's saying. But you're not getting your principal amount back, right? Redeemable and traded is saying that that is your investment has a maturity date. The principal amount you paid or you invested has a maturity date. That is redeemable and trade, and it can be traded. At least we know the market value. So when you are given a question and you can see the market value and all of that, that means it is traded. And convertible debt. So this just give you as an investor or bondholder the ability or the option to convert your investment to equity or cash. You collect your money back, right? And the formula for irredeemable and non-traded is just this. K, cost of debt is equal to interest post tax. For irredeemable and traded, it is cost of debt equal to interest post tax over market value x int. And here, cost of debt is equal to IRR. And there's a particular formula for IRR. I'll write that for you later. And for convertible debt, it is, we want to convert to equity now. It is equal to the price bracket 1 plus G raised to power N times our numbers of shares. So these are the formula. And let me explain it to you, right? Because it's not just about cramming. You can cram, that's completely fine, but you know, anything can happen and you can just forget. I told you this is where what I said becomes interesting and very clear to you right now. I told you that anytime you see cost of equity question, just try and find out the income and the outflows, right? Yes, because using dividend valuation method, I told you that you consider the amount of dividend that is being paid by the company to you, right? In order to determine the cost of equity. Here as well, you determine using the interest. So here as well, using the interest-based approach, you determine the cost of debt by considering the amount of interest paid. So how much is the interest paid? You have it here, post-tax, because interest is a tax-deductible item. I don't know if I should explain that now. I don't want to lose my thoughts, but that is a tax. That is, when you have a profit, right, you are still going to remove interest before it is being taxed. But don't worry, I'll go there later. So irredeemable and non-traded interest, then consider post-tax 1 minus T here is tax. Simple, right? Don't forget, what is the inflow? Interest is the inflow that I received, that the company paid me, the lender. I am the lender. I am the investor. So irredeemable and traded is saying cost of debt is equal to I interest over MV x int. Can you see that now? That means it has a trading value, it has a market value, because it say it can be traded. So that is the difference between these two. Non-traded means there is no market price. Traded means there is market price. Simple. And redeemable and traded is talking about IRR. And IRR is the rate that makes MPV equal to 0. I'm going to specifically talk about IRR later. And this convertible debt, this is it. I told you that you have an option to either convert to equity or receive cash, because they will pay you later, right? So this is the formula, and this formula is just like future value, right? It's giving future value stuff. So this is like the present value bracket 1 plus G. This is like the rate. I'm just trying to find a way to connect it together. Raised to power N, then times numbers of years. That is meaning of R. So that makes sense, right? So let me quickly talk about IRR now. Let's move on. Let me talk about IRR. Write out the formula for you. So I want to write the IRR because I don't want to claim these guys. So IRR, which is the same thing as KD, cost of debt, is equal to lower rate plus MPV of lower rate over MPV of lower rate minus MPV of higher rate. Can put it all into brackets, times higher rate minus lower rate minus lower rate. So this is it. This is the formula. So let me try and explain this formula to you again. Cram it, do whatever, but I just want you to see it. I told you that cost of debt is the minimum required rate of return expected from an investment, from the investor's point of view. If that is true, right? Let's see if that is really true, because here is saying cost of debt, which is of course the minimum required rate of return from your lending, or right? So this is KD, right, is equal to interest, that is the interest, removing the tax, all over MV. MV is like an outflow, the trading amount, the amount of money or the cost that you bought that particular bond or debenture. That is the market value. So market value is an outflow, while interest is an inflow. So it makes sense. A very good example could be return on capital employed. For example, return on capital employed. I believe the formula is earnings, which is an inflow, over capital employed. And capital employed is like capital you employed is an outflow, right? It's just like total asset minus current liability, right? So the amount you just like return on investment, or even what you discussed, saying when we talked about Gordon's growth model, and we said Gordon's growth model is G equal to R times B, right? Where the R is return on investment. So R is equal to return on investment. That is return. And what's return of investment? PAT over opening net asset. Can you remember? Exactly. So return on investment. So this return is on the investment, which is an outflow. So similar to these two, interest is a return on the outflow, the investment, how much you paid to buy shares or to buy bonds or debentures. Does that make sense? It's simple. So you are just considering the inflow and outflow. So here we are talking about NPV. What is NPV? NPV is simply the present value of future cash inflows minus present value of outflows. That's NPV. The difference between the discounted, or the difference between the present value of future inflows, cash inflows, minus present value of cash outflows. That's just the meaning. When we solve questions, you will understand better. Now let's move on to the next one, which is the risk premium approach. So what is risk premium approach saying? Risk premium approach is saying that we determine the cost of debt based on the risk attached. That is, it shows the relationship between the risk and the returns, right, on the investment, which is of course the cost of debt we are calculating in the first place. And it's similar to CAPM approach, right? So I'm saying this because even if you forget this, if you can remember CAPM, you should be able to remember this. So what is the formula? The formula is also similar. KD is equal to risk-free rate plus credit risk premium. That's that. Risk-free rate, we already know what the risk-free rate is. We explained that in the previous classes, right? So credit risk premium is just talking about the risk attached. This is where the risk is. In CAPM approach, remember we said CAPM is KE is equal to risk-free rate plus beta equity. This is the risk, right? But here it is not beta equity, it is credit risk premium. So, and this credit risk premium is usually in ratings. It could be A, could be A, and it could be A, right? You just say 3 star, 2 star, 1 star. The highest, this has the highest rating, which means it has less risk, right? Then this has the lowest rating, that it has the highest risk, and they'll just attach BP to it, right? So this, for example, could be 20 BP, this could be 50 BP, and this could be 80 BP. So 80 pp is the highest amongst this guy, and it means it has the highest risk. So they can say the company has 80 as a rating of A. What is the rating of A? This is the risk. So what we just do is, now what is the risk-free rate? We are given risk-free rate. Risk-free rate will now be KD will now be equal to, if the question says the company credit risk premium or the company's rating is A, then risk rate is of course usually 5% plus 80 So just write the 80, then write over 100. Then the answer, this for example is 0.8. So that means the answer will be maybe 5.8. You can confirm that to your calculator. But I'm just coming up with this from my head, right? So that is that. So if you want to remember very well, BP, just remember blood pressure. So the highest blood pressure is terrible. So the highest BP is the worst company to ever deal with in terms of credit worthiness, right? And this makes sense, as I've said, this risk premium approach, because it's trying to measure the risk attached and the returns. Because see, if you want to borrow money or you want to raise capital, from the public, for example, you want to raise 50 million from the public, how are you going to do it? You're going to issue out debt instruments, right? It could be bonds, it could be debentures, it could just be bank loans, right? Or notes, or you get what I'm trying to say, right? So when you issue those notes out, or when you issue bonds out, then you get the money, right? But there are risks attached. So the difference, for example, bonds, for example, the difference between bonds and debentures, I think, is the security and the risk involved. Bond is more secured and of a lower, as a result of a lower risk, but debenture is unsecured and higher risk. All right. For example, if you for example, a company that is issuing bonds to you is saying to you that, don't worry, my risk, I will not default, I will pay back your money, and if I'm not able to pay it back, my office building is secured to pay you back, or is that physical asset that will reimburse you if I default, something like that. I'm just trying to come up with something. So that is just by the way. Anyway, so I think it's time to solve questions. Is there anything I need to explain here again? Yes, I think there's another formula that you need to know, and that's, I told you that this cost of debt talks about inflows and outflows. So when you are getting paid interest for maybe 5 years, 10 years, you can't keep computing year 1, year 2, year 3 down to the 10th year, right? So there is a way you can put everything together using a formula called annuity formula, and it is giving us, this is the formula. I hope you can see annuity formula. Don't worry, when we need it, I will let you know. It is 1 minus bracket 1 plus r raised to the power minus n over r. This is the formula. So if you want to remember well, or you want to easily remember, just remember that it is 1 minus present value, the formula for calculating the present value, over r. The formula for calculating the present value is this, or discounting, yeah, it's the same thing, present value of future cash flows. So 1 plus r raised power minus n, this is the number of years. So this is the formula basically. What else do I need to talk about? I think that's all basically. I think I've explained everything. So here are the formulas, the major formulas. This is the IRR, which is the same thing as cost of equity. So wherever you see any question that says redeemable, the maturity date is 5 years and the investor is expected to receive a certain amount of money, that is IRR. So let's just do something. Let's solve questions.